What is a C-Corp? Everything you need to know. When discussing corporations, people often use the term casually, equating it with large businesses. However, the concept is more intricate than that. For individuals seeking a comprehensive understanding of appropriate business designations, distinguishing between a C-Corp, an S-Corp, or an LLC and other business structures is vital. If you're considering opening an LLC with Zen Business, feel free to utilize the link provided in the description. Corporations stand apart from sole proprietorships, partnerships, and LLCs due to distinctive attributes. A corporation functions as a unified entity encompassing shareholders, directors, and officers who work collectively. As a legal entity, a corporation maintains separations from its shareholders, meaning shareholders are not personally liable for corporate debts. Corporations are also subject to specific legal or tax obligations that other business types are not. A C-Corp is a prevalent form of corporation and can be seen as a default verity. Its tax designation, rooted in the subchapter C of the Internal Revenue Code, defines it as C-Corp. Under the C-Corp designation, the corporation initially pays corporate income tax by filing a federal tax return as mandated by the IRS. Shareholders substantially pay personal income tax at the individual level for gains arising from dividends. C-Corps have minimal restrictions regarding share ownership, permitting businesses and entities from both within and outside of the United States to hold ownership. The total number of shareholders is unrestricted. C-Corps, like all corporations, must adhere to corporate formalities to maintain protective measures. Although nothing can replace advice from licensed legal and tax professionalists, understanding the advantages and drawbacks can guide businesses to the right direction. Advantages: no limitation on shareholders' number or identities, limited liability for shareholders, directors, and officers, easier equity financing compared to S-Corps, investors tend to favor C-Corp, issuance of multiple stock classes, a lower maximum tax rate than the highest personal tax rate applicable to S-Corps, sole proprietorships, and partnerships. Disadvantages: double taxation, where earners are initially taxed on the corporate income and then again as personal income for shareholder dividends. Lack of personal write-offs: shareholders cannot deduct business losses from personal income statements as some S-Corp shareholders and members of other business structures can. Greater regulations, government oversight, complete tax rules, and corporate formalities, and more expensive and time-consuming startup process. Although C-Corps are common, they might not always be the optimal choice for businesses' designations. So suitability depends on specific business circumstances. Here are several other prevalent options. S-Corp. Similar to C-Corp, S-Corps consist of shareholders, directors, and officers, adhering to corporate regulations to ensure personal liability protection. However, S-Corps avoid the double taxation faced by C-Corps. Operating as pass-through entities, S-Corps enable income to directly reach shareholders without initial corporate income taxation. In essence, an S-Corp combines partnership tax privileges with corporate safeguards. Nonetheless, S-Corps are subject to various rules, including a 100 shareholder limit and stringent requirements for entities eligible to become shareholders. For a scenario where liability protection stemming from a legal separation between the business and its wholesaler is not necessary, a sole proprietorship must suffice under specific circumstances. This structure is uncomplicated for single-owner businesses, offering minimal regulatory burdens and high control and flexibility. However, without a distinct business entity, there is no legal distinction between business and owner liability, making the owner personally responsible for any business-related legal or financial complications. Partnerships share similarities with sole proprietorships concerning liability and taxes. A partner in a general partnership, akin to a sole proprietor, reports their share of income, expenses, credits, profits, and losses on a personal tax returns, paying personal income tax rates and assuming personal business liability. Balancing partnerships, simplicity and flexibility with enhanced risk protection and corporate tax advantages, and LLC is attractive to many. LLC owners, referred to as members, escape personal liability for business obligations. While members generally pay taxes similar to sole proprietorships or general partnership owners, an LLC can also choose to be taxed as a C-Corp or an S-Corp. There's no universally ideal business or tax structure. The selection hinges on each business's unique circumstance. Business owners should seek guidance from legal and tax experts throughout the process.